and welcome to my channel. For those of you new, my name is Dave and I work in financial services, and these videos are mixed into a journey towards financial freedom, financial well-being, financial products so you, like me, can reach your goals sometime in the future. Now let's get into this latest video. Now this video is about my stock and shares ISA account for the month of March 2024. Now it's not to boast or brag or say look at me, but it's to say, well, if I can build a portfolio of over six figures, you can too if you take the right steps, the right plan, and put up an action in place. So let's dive into the video. First of all, what are the objectives? Well, the aim is an annual return of 10% year on year. For this year, 2024, we're looking at dividends of £3,600 a year, so an average of £300 a month. I'm looking for a year-end portfolio value of £113,000. So what's it done in the month? Well, a very good month. Start of March, it was worth 97,406. The end of the month, it was worth 105,868. So a profit in the month of £8,462. And as I say, quick comparison, the FTSE has gone up 2.8% during the first 3 months. So a very nice profit. We made contributions, look at the following chart, of £3,317. So for the tax year to date of £17,347, nowhere near our threshold, but a nice solid contributions. And what about our platform provider fees? Well, they've charged us fees of £13.95 based on a percentage of the value of our portfolio, and shall we say predominantly UK based. If you look at the following graphic, shall we say UK based in Europe makes up 59.58%. USA and Americas makes up 27.53%, and Asia and emerging markets makes up 12.89%. Now we did receive some dividends in the month. Again, look at the following graphic. We received a grand total of £30.06, £6.78 from a mid-cap fund and £23.28 from an AIM fund. So year to date, £82.11, well below our threshold of £900 or expectations, but we will have some very good months in April and May, and we will recover. But across the portfolio, our shares are giving us average yield of 5.62%. So let's dive into the portfolio and see what sort of holdings we own within the plan. Well, first of all, we'll do our shares. We own £47,695 in shares, makes up 45% of our portfolio, of which 38% in the FTSE 100 and 5% is in the FTSE 250. We own 10 shares, 7 in profit, 3 in loss. Now they're my own personal opinions, predominantly based on financial services, what we know about, but they're all considered to be the long-term holds, and we see no reason why we're going to sell any of them shares in the foreseeable future. They were bought for a specific reason. Look at the following graphic, a quick overview of the 10 holdings we hold. So our largest holding is Legal & General, the insurance company. 3,957 shares, makes up over £10,000 of our portfolio, 9.5%. We can just switch off, it does what it says on the tin, safe to go boring, everyone needs insurance. It's a big pension player within the UK, and it's getting a very nice yield of around about 8%. Our next holding is Lloyds Banking Group, 19,189 shares, nearly £10,000, 9.4% of the portfolio, and it will give us a very nice dividend, paying about 4 to 5% yield within the month of May, and it will be reinvested. Our next holding is back onto the insurance companies. We know Viva, 1,774 shares, £8,800, makes up 8.3%. Again, like Legal & General, everyone needs insurance. It's got very good assets under management, has been streamlined the last few years, but it is paying a very nice yield, again of around about 8%. We can just switch off. Our next holding is away from the bank and insurance company, is Card Factory Retailer. 3,738 shares, £3,500, makes up 3% of our portfolio. Has got very good high street presence. It is trying to make some online presence. It is struggling, but it is cash rich, but it doesn't pay a dividend because of banking restrictions during the COVID. But profits should be very nice, shall we say, when they're increased or when they're announced next month. Our next holding is back on the banking sector is HSBC. 495 shares, £3,000, 3% of our portfolio. It was done away from, shall we say, UK banks, predominantly based in, shall we say, Asia but it has struggled to last quarter results, but it is paying a very good quarterly dividend, and it will pay a special dividend as it's just sold off its banking operations in Canada. We can just switch off, it is done for a reason. Back onto the banking shares, we own Barclays, 1,588 shares, nearly £3,000, 2.8% of the portfolio, and it will give us a nice dividend at the start of April. Yield is around about 5%. Back onto the shares, we own NatWest, 957 shares, £2,500, 2.4% of the portfolio, and again, some very good results, paying a nice yield. Dividends will be paid at the end of April, and one significant factor is the government will now reduce the holdings down below 30% ahead of an impending sale. So let's see what happens about the time frame, and let's see what happens about the price when the shares are offered to members of the public. But it's no longer a controlling investor. Away from the banks, we own Sainsbury's the retailer, 881 shares, £2,400, 2.4% of our portfolio, and hopefully will give very nice results, shall we say, next month in May. But it was done for a reason. Everyone needs to eat, everyone needs food, and it is cash rich, and it has been on the streamlining and a cost cutting exercise over the past few months, and the dividend increased again on the last results of the end of last year. Back onto the insurance or the pensions market now, we own Phoenix Group, 421 shares, £2,300, 2% of our portfolio. It has been buying other companies, shall we say, Reassure, Standard Life. Very cash rich, and it is paying a dividend of nearly 9%, and during the month, profits will increase, dividends will increase substantially. But we've done it for a reason. It's a subject we know about from our day-to-day job. We own AJ Bell, the platform provider, 724 shares, £2,200, 2% of our portfolio. It's what we've seen as a growth company. Assets under management increased, customers decrease, it is growing. It does pay a small dividend, but the dividend's been increased, shall we say, but it's done for a reason. Everyone's time seems to be investing on platforms, but let's say it's a long-term player. So a collection of shares predominantly based in financial services, what we know about, but some of them are bought for very nice yields. We've not got some great dividend this month, but April and May, it will be a complete game changer. We're going to be way back on track because of recent results in February and the start of March. Remember, these are my own personal opinions. If you like the videos, smash the like button, subscribe to the channel. Now let's see what sort of funds we hold within the portfolio. Now, in regard to the funds, at the moment we own 10 funds, 5 in profit, 5 in loss. Total fund value of £53,000, so it makes up 54% of our portfolio. Now, we were predominantly based in shares, predominantly in the UK, so we are increasing our funds on a regular basis to get away from, shall we say, the UK sector or bias. Our largest holding is a passive adventures fund, £22,500, 21%. Does pay a small dividend, but it was done for diversification. We can just switch off. It was bought across numerous sectors. Our next holding is Legal and General Technology Fund, £12,100, 11.5% of the portfolio. Does pay a small dividend, but it's solely a growth company, and the tech sector has had a very good run recently. Hopefully that will continue. Let's just say probably the big 7, but it was done for diversification away from the UK sector. We have increased that during the month, and we've also increased our next holding is a Fidelity World Index. Primarily a tracker fund, but it does pay, shall we say, a small dividend. Will be at the end of April, but it does have very low fees of 0.12%. £7,700, 7.3% of portfolio. We can just switch off. Our next fund has struggled lately. It's a China fund, £2,300, 2% of our portfolio. It was done to buy, shall we say, within a certain sector, but it's struggled ever since. We've also got an emerging market fund, £800, 2% of our portfolio, and a second emerging market fund of £1,200, 1% of our portfolio. These are the funds that have struggled within our portfolio. We own a mid-cap fund of £700, of 1.6%, and our smallest fund is the Russia fund, but thankfully it's about £600, but it makes up 0.25% of our portfolio. So a collection of shares, shall we say, but we were, shall we say, diversification. Now, the month we've set aside some money for a specific purpose in mind. So we've created 2 new funds for a specific reason. We don't want to add to our existing holdings. We want the money for a specific event in future. Now we've kept it simplified. We've gone for 2 trackers. We've gone for an S&P 500 fund. We put £3,000 in, nearly 3% of our portfolio, and we've done an HSBC All World Share Index Fund of £5,300, 5% of our portfolio. But we've done it because we just want to put money in the market, better than the Bank of Broad Society, but we may want that money for a specific event within the coming months. But we've ring-fenced it from our existing holdings. So a collection of shares, shall we say, of funds, predominantly based in trackers. We can just, shall we say, does what it says in the tin. It was done for the diversification. We may simplify the funds moving forwards. Let's just say when the China funds, the emerging market funds, or the mid-cap funds get back in profit. But at the moment, we're not prepared to sell at a loss. But we are increasing certain holdings, such as the LNG Tech Fund and our Fidelity World Index Fund, on a regular basis when we make contributions. So as you've seen during the month, a very nice return of over £8,500. Remember, it's not a get-rich-quick scheme, but it proves if I can build a portfolio of £100,000, you can too, by taking the steps, taking the plans, and remember, put all your investments in a tax-free wrapper. So all dividends are tax-free, all your growth is tax-free, there's no need for self-assessments, there's no need, shall we say, for capital gains declarations. Remember, if you like the videos, smash the like button, subscribe to the channel, and we'll see you again in the next video.